This is part 3 of the financial and savings mini series I put together. Hope you gathered a lot from parts 1 and 2, but there's a lot to cover, so I'm going to go right into it right here. So no intro on this one. Saving money throughout my career, I had 3 savings accounts, I guess, if you want to call them that. So the first one is the bank. You can see that on the left. The advantage of the bank is it's liquid, it's safe. You could get your money anytime. That's what I mean by liquid. You could get your money anytime. And you need a bank account to pay your bills, get some cash, all the short-term stuff. It's safe. Your money's not going to fluctuate. You deposit 20 bucks, the 20 bucks is going to be there. The negative is down below, you see no growth. The bank isn't going to give you much interest. So you'll probably get 0.03% interest or something really low. So not the best place to grow your money. The second type of account I had, right there, right under number 2, are the mutual funds. So back then, when I was younger, I didn't want to stick all my eggs in one basket. I wasn't trusting the mutual funds too much. I didn't know what they were. So I just took a gamble and I went with 3 different mutual funds. I divided up my money into 3 different brokerages. And luckily I did that because one brokerage actually did sell out and sold all my shares to a bigger brokerage at the end when they went bankrupt, pretty much bankrupt or out of business when September 11th hit. So basically they sold my shares pennies on the dollar. So I lost money there. So you can lose money, but it takes a really tragic event like 9/11. I haven't seen anything since. Even the pandemic and the 2008 financial, the financial problems we had, the downfall, didn't put any brokerages that I saw to bankruptcy. So pretty safe. But anyway, for the mutual funds, the advantage up on top there is growth potential. The disadvantage is you can put your money there, but if you want to withdraw it, it takes 3 to 7 days to get your funds. And that never bothered me because the money that I put in my mutual funds were there for medium to long term. I wanted a place that was accessible and a place that I can get my money, but at the same time would grow more than the bank. And that was the mutual funds. So I kept my money there. And I don't know, 6 months, if you're not going to touch your money for at least 6 months to a year, or if you want to just keep it there and be able to withdraw it before you retire without any penalties, then that's where I recommend you put it. In a stock, where I put it was a stock-based index fund. And then finally, the third type of account I had was a retirement account, an IRA and an educational IRA. So the IRA, you could have Roth or traditional, like I explained in my second video. The advantage of the IRAs, the ones in green, are that you get tax benefits. You don't get taxed on your profits. So if your money grows, you don't get taxed on them. And please read the fine lines on the Roth and IRA. You do get taxed when you withdraw, or you get some tax benefits before. But those are, I won't go through that here. You'll be able to read that up, and it's pretty easy to figure out. So that's what an IRA is. You can only access it, I believe it's 59 or 59 and a half or 60, somewhere there. But you do get tax breaks. And then for an educational IRA, it works the same as an IRA where you get tax benefits. You don't get taxed on the growth. But for the educational IRA, you could take it out before you retire. The money just has to be used for educational purposes. So tuition for your child, for yourself, all that stuff, you could withdraw from the money you put in an educational IRA, you can withdraw for educational purposes without any penalties. For an IRA, if you do need to withdraw, there's an emergency, it's like a 10% penalty that you got to pay. So just look into that. The rules are always changing, they change sometimes, it's not always, but they change sometimes. And going back to number 2 and number 1, there for the mutual funds in the bank, you can withdraw at any time. There's no penalties or anything like that. let's go over the Vanguard 500 index fund. I picked this fund just as an example. Obviously, you could pick as many different funds as you want, but I went ahead, let's go ahead and do this one as an example. You could also check out all the different indexes like the S&P 500 and the Dow Jones. You could find all of these charts and these summaries in the Yahoo Finance web. There's nothing particular special about Yahoo Finance, but it is just a source, right? I mean, you can go to Google, you go to any of the websites, you could even go to Vanguard itself and do it. But I just picked Yahoo for demonstration purposes. And I believe by going Yahoo, it may not be as biased as if we went to the actual Vanguard website. But if you do want to open a Vanguard account, you have to go to the Vanguard website. If you want to open a Schwab account, go to the Schwab website, etc. So you go to those websites, you open an account, and that's how you could buy these funds or their mutual funds. So just going off of the hopefully neutral Yahoo Finance page, looking at the Vanguard 500, it's important to note that when you invest in something, look at it directly. Even though this Vanguard 500 mimics the S&P 500, like I'll show you in a second, you want to track Vanguard 500. Don't be tracking the S&P 500, even though the Vanguard 500 is doing it. And the reason for that is the prices will be different. And you just want to, if you want to go straight to the source of where your money is, then go straight to the source. Go to your actual mutual fund. Don't look at the indexes. So Vanguard 500. So if you see the summary page here, you could see the graph. We already talked about how to interpret graphs. They have their values, their dollar values on the right side of the graph here, the 710, 700, all the way down to 630. Normally, in an engineering and mathematical sense, it's on the left side. The axes, the y-axis is on the left side, like I showed you on the other charts. But that's fine. I mean, they chose to put it on the right side. I guess that's financial for you. Down at the bottom, you can see the price there, 693.68. That's what it closed at yesterday. Remember, mutual funds, they close when the Dow closes, when Wall Street closes. And you don't get the new closing price until 4 p.m. Eastern time, right? 4 p.m. Eastern time when the Dow, when Wall Street closes again. So for today's prices, we got to wait another hour. It's 12 o'clock here on the West Coast, so another hour, and then it'll show you the closing price. But as of yesterday, it was 693.68. If you look down below, you have the 1 month, 3 month, 6 month. Here, I'm tapping it all. Before I invest in something, I look at the whole big picture. You don't want to look at 1 month because that's only a small 1 month snapshot of the whole fund. So I always go to at least a 10-year, but I also do the all. So between 10 years and all, 5 years is a little too short for me because I like going long term. So in this case, let's do the all. So back when it started, or roughly when it started, let's say March of 2001, you see that little box that opened up. The closing price for that day, whatever day I picked there, was $107.08. Open means, when they rang the bell at Wall Street, when they opened up the stock market, it opened up at $114.78. Throughout the day, the high was 117 and then the low was 103. All you have to worry about is the close. I mean, don't worry about these little deviations there each day. That'll drive you crazy. And if you're in it for long term, it doesn't mean anything. So on March 20, 2001, whatever day that was, it's hard to tell the day because of the time span, it was $107.08. So let's say you had $1,000 worth of cash and you bought into Vanguard 500. So you just divide $1,000 divided by 107.08, which is the price, right? I mean, it's straight up math. So you would end up with 9.339 shares. The shares don't have to be whole numbers. So if you had $1,000 and you deposited into Vanguard, they're going to give you 9.33 or 9.34, let's just round it up, 9.34 shares of Vanguard 500 index. And those shares are yours. You got 9.34 shares. And depending on the value of those shares as they go up and down, that's how much the value of your investment is, right? So let's go here. So let's say let's say you didn't do anything else, you didn't invest anything else, you just kept those shares, you didn't add to them or anything, those 9.34 shares that you own. So let's go here. If you decided to share, if you at this time in May 2007, if you decide to sell your shares, they're worth $141.38 each. So times 9.33. So if you'd sold all your shares there, you'd have you'd get $1,320 back. So not bad. Your money grew, right? Your money grew from $1,000 to $1,320 in that time span. So you went from in 2000. So in 6 years, it grew $320. If you didn't do anything else, you just sat on it. Now you may think, well, $320, that doesn't sound like much, but it is kind of a lot. I mean, compared to $1,000, 320 is about 32%, right? So you made 32% profit in those 6 years. If you were to put it in a bank and you made 0.1% profit or whatever, your $1,000 will be worth probably $1,010. So you made more profit. But that's not, but what I advocate is don't just do a one and done deal. Don't just throw 1,000 there back in 2001 and stop there. You want to consistently, hopefully monthly, keep putting money away. Put away $100, $200, $300 a month. And as you do that, you can see here on the graph, you started back in May, where it was, what was the price? $100 something a share. And as you keep on buying more shares every month, see the prices change. And so right here, where it dipped down to $75 a share in September 2002, you would buy more shares with your $1,000, right? Because the prices are lower now. $75. You put out, $1,000. We'll just say 1,000 just to keep it standard. You put out $1,000. You're buying more shares because the shares cost less, $75. And if you keep putting $1,000 away every month, the price will fluctuate. So in this month here in November, it was $86 a share. So obviously you'll buy less shares than the $75 a share. Keeps going. So as the prices go down, you're going to buy more shares. As the prices go up, like right now, here in February 2004, it's $106 a share. So now you're going to buy slightly less shares because they're a little more expensive here. So it's a good and bad story. It's the prices go up. You're only able to buy less shares with your $1,000. But the good news is all the shares you've bought in the past are now worth more. So now your total money is worth more. And I bring this up about the whole every month when you put a set amount, and sometimes you buy less shares, sometimes you buy more shares, depending on the price. That's what's called dollar cost averaging. It's another definition there. So just remember that, dollar cost averaging. As it goes up, you buy less shares with your set money. As the prices go down, you'll buy more shares. You'll accumulate, you'll buy more shares as it goes. So dollar cost averaging is great because you're not taking a big hit or a big loss one way or the other. You're buying less when they're expensive. You're buying more when they're inexpensive. And if you look at the graph from 2000, from November 2000, let's go to the very end, where the closing price is $121 to today. The closing price is, you can see right there on the top right-hand corner, $693.68. Look at that big difference. You go from 100 something to 693. That's if you were, so you make a big profit. You make 5 times more your profit if you were just to buy something on one end of this graph and hold on to it and then sell it at the very, at the present day, which is the other end of the graph, time-wise. you multiplied your money 5 times just from doing nothing. That's great and all, but if you put time on your side and you consistently buy month to month to month, right here, look at you're increasing your shares at this low graph rate right there, month to month to month, whether it's $200 a month, $300 a month, whatever, $400 a month, you do it consistently. Look how your money is gonna just explode. I mean, it'll just keep going high. Like even right here, let's just say right there, let's pick that date right there, in December 2021, right before the pandemic. Compare that to when you started, when it was only $100 a share. And all the shares that you bought that were roughly in the neighborhood of $100, $150 a share for those, I don't know, what was it, 15 years or so, 10, 15 years. And now you reach 2021, those shares that first you'll have a lot of shares if you consistently did it. And now each of those shares have just multiplied big time. All right, so that's how you build your wealth. And along the way, not only did the value of your shares go up, and that's, in addition to the value of your shares going up, Vanguard would be giving you dividend shares. So each year Vanguard was doing well, which it had been, the Vanguard 500 index fund, they would give you dividends, like they'd give you half a share here, 5 shares there, 6 shares here, on a regular basis. So those are adding to the number of shares that you have. And so that is how you can make your money work for you without really doing anything and without taking much of a risk. And that is, to me, that is much better than keeping your money in the bank where it's stagnant, or keeping your money in bonds, or keeping your money in a CD, a certificate of deposit. If you're in it for the long run, I believe this is the way to go. You go pedal to the metal. If you want more and you're in it for the long run, why are you going half speed with bonds or low speed but safe in the bank? You want to go pedal to the metal, right? Full throttle. And why diversify? Why say, well, I'm going to get part stocks, part bonds. Now you're like halfway. You're doing pedal to the metal, then you're pressing the brake a little bit and going slow and cruising, and then you're going pedal to the metal. No, if you're in it for the long term, this is my personal opinion, and it worked for me. Go pedal to the metal. Why take shortcuts or go slow? Okay. Here's another important point and myth I want to dispel here, or perception I'd like to dispel. See where we're at right now, December 2021. We're at a peak. And when that was at prior to the pandemic, right when the pandemic hit, we went down to this dip here. So now the prices went from 600 something to 350 something. Did you lose money? If you cash out at this point, yes, you would lose money, but you would lose money from the value of December 2021 to now. Would you lose money overall? Absolutely not. If you were investing back here, right, regularly, and you sold up here, you're still selling for $330-ish a share when you were buying all your shares here for 100 something a share, really low prices. So are you going to lose money even if you cash out at this juncture? No. And that's what I want to dispel, is like a lot of people out there say, oh, at any one time you could lose 30% of your money. And that is not the whole truth, because right here, from the peak, from that peak right before the pandemic, down to that was like what, 439, down to this, to 3 something. Yeah, it was about 30%, 25-30% of a loss. But it's only a loss if you went from that peak down to this valley, if that's the only time frame that you invested in. So yeah, if you invested, $10,000 or whatever right here that one time, and then you sold right after the pandemic hit, and you sold at the low one time, yes, you're going to lose 30% of your money. But that doesn't apply to you, right? Not with the strategy that we have. The strategy being, you consistently save every month, then that 30% loss does not apply to you. You're not getting a 30% loss of all your money. So again, don't let that scare you. Yeah, if you're like me, I was saving, not this specifically, but let me just say, I was just saving, and people say, well, now that you're retired and you have your money, why are you keeping your money in the same stock fund? It is a stock fund. Why are you keeping your money in the same stock fund when you could lose 30% immediately? And my answer to them, I don't even answer that. And people don't really ask me that. But if someone were to ask me that, I would say, I'm keeping it in there because what are the chances of another pandemic, worldwide pandemic hitting? And if it did hit, I'm not losing 30% of my money because I invested way back here right before everything happened and rose. So even if it loses 30% for that instant, for that short amount of time, I'm still ahead. I am still ahead. And I will not cash out. I don't have any plans cashing out if it does go down at that, second, God forbid, another pandemic hits. I would just hold on to it and hold on to my stocks and look what happens. Just like in the first pandemic, you eventually get out of it and it rises up. So I would say the only reason why I would shift any of my money into the bank and remove it from a stock fund like this and shift it to the bank or shift it to bonds or a certificate of deposit or something safe is if I knew I would need that money soon. So for instance, let's say I had 100K in this and I wanted to put a down payment on my house in 2 months, and I needed all 100K or I need 75K or whatever, some big amount. Well, in that case, yes, I would shift my money because in the short term, I'd be looking to cash it out. And I would not want, even though the chance is remote, whether the war in Iran picks up or who knows what, I would not want that to fluctuate in the next couple months and me take a loss that way. So that would be the only reason why I would be going conservative is if you need your money very soon and you can't afford to lose any of it because you need that money. Other than that, in my case, I'm retired, yes, 55, 56, and I'm not, I'm hoping I'm going to live another 10, 15 years, at least 20 years. So if I'm in it for another 20 years, why would I shift my money? And I don't need to withdraw my money anytime soon, at least big amounts. Why would I shift my money away from this kind of curve? So I would just let it ride. All right, another point I want to make real quick is you could see some dips here. So let's go back here. All right, 2001. Sorry for this. Let me see if I can stretch it out. I guess I can. So you see a dip that goes right here. That was because of the tragedy, September 11th, 2001. You don't see the dip too much because the scale is big. It goes from 100 to 693. You can see here. So this is kind of smashed in. But if we expanded the scale, I can't expand it. But if you expand that scale, it's a big hit, right? It went from $102 to 81. Yeah, 81. So it's a 20%. It was a 20% hit right there. Your money would decrease by 20% because of 9/11. And yeah, we have bigger things to worry about. When September 11th hit, we had a lot of bigger things to worry about. But as far as the finance piece, that's the effect when something tragic, when something really big happens. Here in 2008, the financial crisis happened, and you could see, when all the mortgages and banks and all that stuff lost their credibility, and I mean, just a lot of stuff happened. Then there was another dip. You went from $118 down to $68. So that's, I don't know, 40% dip. It was a big dip, right? But then we recovered again. And then let me point out another one right there that we just talked about, the pandemic. Big dip. It was about a 30% dip. It went from there to there. But in all cases, whether it's tragedy of 9/11, the fiasco with the 2008 financial crisis, and the tragedy also of the pandemic, we've always recovered. The stock market, and you could look at this at any stock-based fund. All the stocks, the companies have always recovered. And so look at those worst case scenarios, and hopefully we don't see another 9/11 in our lifetimes. Hopefully we don't see another pandemic in our lifetimes. And if we don't, then the picture gets rosier. If we do see another war, Iran war right here too, you could see it take a dip. But any kind of unfortunate, horrible tragedy, any kind of event, you could see historically, the market has always recovered. And so that is why I say it's an acceptable risk. You keep your money here and you invest regularly, consistently, and it shows, I mean, with this big sample size of 40 years, it shows that the market is always resilient, and that's capitalism for you. A lot of motivated companies out there that are trying to put out the best services, the best products, make the profit, and just good old American ingenuity, right? I mean, we just keep going, and so we live in a capitalist society, and that's the way it is, and that is why I personally went stock based. Okay, enough of that. So that's the Vanguard 500 index fund. You can also use this to research up here. You could, Schwab, you could do whatever, Schwab, S&P 500 index, right? And it shows you the graph again. Again, go to the 10 years or the all, shows you the graph. They're pretty much all similar. But you could do any of your research up there. And just going over this, so you have that. If you want to read about the risk, it gives you a summary of the risk. 80% of its stocks index the stocks of 500 leading U.S. companies. So that's the S&P 500 index, which is basically, which is an index. But Schwab mimics that, and their prices are different. And that's why I say go to your actual mutual fund or investment you go to, because these guys go for $19 a share, right? And that's not any better or any worse than the way Vanguard prices it, but these guys do 19 a share. And if you look at their chart, it fluctuates just like Vanguard did, but you could see their values. So the percentages are the same. Remember I told you Vanguard, your money multiplied 4 or 5 times from one end to the other? Well, it's the same thing here. Same thing here. Actually, these guys do a little bit more. So they went from $2 something to $20. So they went close to 10 times more, 795% to be exact, if you look at it at the bottom. So there's different performance values. And if you scroll down, you can see that the different companies that this mutual fund, Schwab S&P 500, invests in. NVIDIA, 7.84% of its assets, Apple. This is getting too much into the nuts and bolts. I mean, I just look at their performance, and I don't go into this level of detail. I mean, you can if you're curious, but that's S&P 500 here. If you do an index fund, this is what S&P 500 is. If you do some other fund, they'll tell you what they have their holdings in. Anyway, so that's it. Technology, financial services, the sectors that they invest in. So you could see that technology is the big, where they hold most of their assets, right? And you could, I won't go through all of these things, but you could just do your own research on historical data. If you want to look at it tabular in a table form, you could look at, let's see, the holdings we already discussed, sector weights. They do mostly technology-based funds, and purchase info. It says here that it shows the minimum initial investment is 0. So you could open an account and have zero money. Some of them require 2,500 initially and all that. And then if you look at the brokers, you can see the brokers down here. And if you look to the right here, Vanguard. Vanguard right there. So Vanguard, I guess, sells Schwab funds. But I would just go to Schwab if you're going to buy Schwab. Open a Schwab account. Vanguard might charge you a sales fee or something. Who knows? I don't know. I've never went cross-threaded like that. So you could see all these brokerage companies. One bit of advice is I did a lot of research, and this is where you get, be careful how deep you go, because back in the past I went real deep and I found this brokerage, Burger 500 or Burger 100, and it had the good deals, low, no sales fees or anything like that. This was back in the 90s when I was still young, and I said, wow, this is great. So I started investing, $300-400 a month, and unfortunately they went bankrupt. So it is possible for a broker to go bankrupt. It was really sad. It happened at September 11th, actually. So all the money I invested in there, they took all my shares and they resold it to a different brokerage, a bigger brokerage called Janus. I don't know if Janus is here. It's not JP Morgan, but it's called Janus Funds. So Janus Funds took it, and unfortunately, when Burger sold to Janus, they sold my shares for low price because it took a dip. And that's what I mean is you don't want to sell your shares for when they're low priced, when there's a pandemic or tragedy that happens like 9/11. You just hold on to them and let them go back up. But in this case, because Burger went out of business, there was no choice. They transferred my funds and lost a lot of money. But I want to make that point because that just reinforces my point of if you invest early, if you go aggressive, what people call aggressive, when you're younger and you do it early on, even if you do lose all that, it's not like it's the end of your life, right? I mean, yeah, I lost a lot of money. I think it was like $20K or something. And back then that was a lot of money for me and it was a shame, but I didn't let it stop me from continuing my practices. So I kept investing in the same stock funds with a different broker, of course. And I'm glad I did that because had I gotten turned off and went, well, you know what, this is not worth it. I'm just going to do bonds. I'm just going to do the bank. I never want to lose money again. If I would have went that route, I would not have the same growth as what I've experienced now. So don't give up. Don't let one thing just stop you from, or a bad example stop you. I mean, those things are just so rare. It was unlucky, but we had bigger things to worry about. I didn't, and I just kept going with my same attitude, and I'm so glad I maintained that attitude. But so as for brokers, I don't recognize a lot of these. I don't know much of these, but just stay with the big brands, right? Stay with the big brands. So the ones that are advertised nowadays are Vanguard, Schwab, Fidelity. Those are huge ones, and that would be like Apple going out of business or something. And even if Apple did go out of business, if you're in a mutual fund, Apple's just one little share of what these guys invest in. So you're not going to lose your money. If you're in a mutual fund that has Apple in it, you're probably going to lose 1%. And all the other companies will be going up and down that same day. So that's why mutual funds, don't let anyone deter you from investing in a stock-based mutual fund, especially if it's stock index-based mutual fund, because all those companies would have to go broke at the same, all 500 companies, for instance, in this Schwab S&P 500X, all 500 companies would have to go broke at the same time, the same day, the same time, for you to lose your money. And that's not going to happen, right? I mean, what are the chances of that? You have a bigger chance of getting in a fender bender or car accident going to work or tripping on the way to work and breaking your neck or something. The chances are slim to none. So it's an acceptable risk, in my opinion, especially if you're in it for the long term. To wrap up our graph analysis, I just wanted to do a comparison with the Vanguard Intermediate bond index fund, just to for an example of a bond index fund. So again, remember to watch out for the scale. So let's go to all. This is the life of the Vanguard Intermediate Bond Fund. And the graph looks semi-similar. I mean, it doesn't go up like continually up like the stock fund does. But if you look at the ups and downs, it looks like, wow, this bond is pretty active. But it really isn't. If you look at the values on the right, on the side here, on the right side, if you look on the values of the right side, it goes from $9 to $13. I mean, that's not a big range, right? On the other ones went from $100 to $600, $700. So that's a big range, right? $100 to $600, versus $9 to $13. So that's how much fluctuation or safety or conservativeness a bond does. So if you started here, just really quick, if you started in April 1994, it was $9.60. And at its highest point, let's say here you decided to sell because you needed the money and you lucked out because it peaked. You went from $9.60 to $12. So it's a $3 difference. And yeah, it's 30%. I mean, it sounds good, but still it's 30% over 20 years, over 20 plus years. That's not that good compared to the stock funds, which were 700%? I mean, it was like a lot. See right here, overall, I mean, you get 30%. And that's if you sold at the right time. And then it goes down, but as it goes down, you're not going to lose much either, because unlike the stock funds where when the pandemic hit, it went really low, you lost 30 something percent in one fell swoop. Here you lose, I don't know, $2 out of 12, so 1/6, that's not 30%. That's, I don't know, just doing quick math, 8% or something. So even on its worst terms, you're not going to lose that much. But would you like to go half speed though, is the question. Do you want to go half speed for 25 years, 25 years, to go from here, $3 a share, whatever, to there, or $9 a share to $10 a share? So again, it's safe. You're not going to lose money. And people may say, well, that's good because now that you're retired, you don't want to lose money. Yeah, you're right. That's general. Again, specific versus general, right? Detailed versus general. Generally, that's true. But if you look at the details, I don't think it's a good decision to just stay here if you want your money to grow from the risk versus growth perspective. And I hope that solidifies a lot of what I've been talking about as far as the risk and be careful about generalities and all that stuff. Let's go on to the Vanguard website. Just want to show you something I think worth noting. So if you go to Vanguard.com, and again, you go to Schwab.com, T-Rowe.com, MerrillLynch.com, any of those brokers. So let's just pick Vanguard. So Vanguard, there's the website. If you go to personal investors, you can do that. And I just wanted to show that the tools they have. So with Vanguard, see, there's mutual funds, ETFs, money market funds. The ones I want to concentrate on are, and there's also stocks. So let's go to mutual funds. And this is where you can open an account. But let's go to, and let's see all the different types of mutual funds they have. So they talk about why invest in mutual funds, all this great stuff that a lot of the stuff I covered, I hope. Index funds. So let's go shop index funds. Remember, there's the index, which is passive, and there's the active funds, actively managed, where a investment broker goes through and tries to make the best decisions. Index, again, they go after an index. They mimic the S&P 500, the NASDAQ, the committee run, I think it's a government, but it's run by a committee, not by a private vendor. So let's go to shop index funds. So it goes in there. All right, and these are the index funds. So you've got many to choose from, right? You got the 500, the first one there, 500 index fund Admiral shares. You could check that out. And if you scroll to the side here, you could see the year to date, the 1 year average annual return, the 5-year average annual return. So 13% for the last 5 years each year. If you did it for 10 years, it averaged 15% a year for the last 10 years. Since inception, at the year 2000, it averaged 8.89%. And then it says, then if you look at a column over, investment minimum, you need to invest $3K. And then there's the price, $696 a share. You don't have to buy a whole share. If you have $300, it'll be like less than half a share, but it still counts as a portion of a share. They multiply that by whatever the price is. And then the change in price today. So I just wanted to show this. I don't want to go over it too much, but it just shows all the different funds in Vanguard. So there's a 500 index fund, there's a balance index fund, there's the communication services index fund, there's I didn't mean to click that. There's a developed markets index fund. And the emerging market stock index fund. So there's a lot to choose from, and you could go ahead and read up on any of these funds, and for the European stock index fund. So if you go in, you could read about all that stuff. But if you want to stick to the regular, again, there's S&P 500, there's a NASDAQ, there's a Dow Jones Industrial. So if you just want to keep it simple. But any of these funds, they have their risk levels, they have their expense ratios here, the 0.05%, 0.06% for emerging market stock index and all that. And then you could look at each of their returns. So now you're kind of splitting hairs, just looking. Again, just remember, there's a big difference between stock funds and bond funds. So if you go down here, look at the bond fund, the intermediate term corporate bond fund. So let's go through. Look at the rates they have. Negative 0.19%, that's year to date. 4.26% interest for 1 year. For the past 5 years, it was 0.08% per year for the past 5 years. For the past 10 years, it was 2.84% for the past 10 years. So safe, 2 for risk levels, which means it's not too risky, but you could see the growth opportunity that you have, or what has happened for the growth in these past 10 years. And since inception, March 2nd, 2010, it was 4.23%. So just an example of go to a brokerage, whether it's Schwab, T. Rowe Price, Merrill Lynch, Vanguard, American Century, all these brokerages, go in there and take a look at the funds that you'd like to, the mutual fund that you'd like to put money in. And one final graph. Sorry about that. I just thought of one important key point here. So again, looking at the Vanguard 500 index fund, and I think you could be safe doing this with any other fund, you'll get the same result. And this definitely applied to my retirement fund, for my work, any of that. And by the way, a retirement fund is nothing else, nothing more than a mutual fund you get, but you call it your retirement fund. So I could have the Vanguard 500 index fund as my temporary fund where I, my intermediate fund where I stick money in and take money out before I retire as my better than the bank type account. And I could also have this Vanguard 500 index fund, a whole separate account, but it goes into this same fund, but it's a separate account, and call it my IRA, my retirement account. So just think of that as if you go to a bank, you could have one account that you call, one checking account, and then you could have a separate checking account because you want to separate your money, but your separate checking account, you might be using that for bills, and then the one checking account you use for money that you spend wherever. But it's still the same bank, it's still same interest rate, all that stuff. And a quick note on the interest rates that I showed you, those are historical interest rates, the 5-year, the 10-year. They're not interest rates where you tell them, well, I'm going to keep it in here for 10 years. And so you're going to give me, 10% it says, so 10%. It doesn't, those are just statistics. So it's just saying if you put your money in that fund in the past 10 years, it had given you 10% of an interest rate based on how the market behaved. So the market could behave better, could behave worse, but the way it did the last 10 years, that's what you got. You got 10 point something percent or whatever the value says. Okay, so this last fund, this is where it's really important. See the dashed line down here? That shows the money, the amount of money a person would put away, or the value of the money if they were investing $300 a month in the Vanguard 500 investment fund. You can see it grows normally like that because you're just paying. That's the amount of money you're investing. So if you were to put it in the bank, that's how your money would be. $300 a month from 2000, I kind of blotted it out, from 2006 to 2025, you'd end up with that amount of money there, which you could read on the top there. $75,000 of total cash is what you invested in, what you put away. If you do that in the bank, you're going to have 75,600, or I don't know, maybe 76,000 by the time it's done with the low interest rate, right? Just the bank. That's the money you put away. Now, the same money you put away in Vanguard, look at this graph. It goes, the interest goes up like this. So you end up with this money. And you could read up on top there, your estimated final portfolio value is 231,000. So you put away 75K, but with the dividends and the way it grew and the way the price changed, you ended up with 231K. Just from doing nothing, just saving money. So that's why, and I know a guy, and example A, example B, I know a person who put money away, the same amount of money that I did, and followed this graph and ended up with some amount like that. While I put my money in a stock-based mutual fund and I didn't end up with this. I'm not going to tell you what I ended up with, but it ended up with a lot more than what that guy ended up with. True story, right? Real life story. And here's where a lot of people, also just food for thought. Some people say, well, I don't make much money. I make, I don't know, 50K a year or whatever. How can I make as much money as a person who's saving and makes 150K a year? That guy has a lot, or gal has a lot more money to save. Well, that's the thing is, let's say you put $300 per month in a mutual fund or in the right place, and you followed this upper curve here and ended up with this for $300 a month. But that other person who might have a bigger paycheck, maybe making 150K, 200K, whatever, decides to save triple what you save. So they're saving $900 a month, which is huge, right? Substantial. So $900 a month, but they put it in the bank, or they don't put it in the right, or they put it in bonds or something. They're going to follow this curve, but instead of $300 a month, it's going to be $900 a month. So it'll be triple. So triple would be, they end up triple of here. So 75K times 3 is about 215K roughly. So they would end up right there. So a person with a higher paying job who's putting away 3 times that you're putting away is still going to end up less than what you put away if you put it away smartly and that other person does not use the same vehicle as what you used. So just, again, food for thought. And that's if you only saved 300. What if you saved 400? What if you saved 350? What if this would grow even more. I just used 300 as an example because, hopefully that's some money you could put away and is not too outrageous to do every month, and you could get there. So it's not impossible to build wealth, and it's not so much about building wealth. What I'm after here is get into that good habit of saving. Just saving money is great, but putting it in the right place is better than just putting it in the bank or someplace that you don't. That's not going to make your money grow. There's better. Do your research, and you could maximize your growth of your money. And that's the end of the series. That was a lot of material. Sorry that they're long videos. Maybe I should have changed it into modules and did that, but I think I covered like 85% of what you need to know. And you could now be dangerous. You can go in there and check out different websites, different brokerages, do your research of their mutual funds, ETFs. Again, we covered all the definitions. So go in there. Great thing about video, you could always rewind and go back. But in parting, thanks for hanging in there. I hope you learned a lot. Feel free to put comments. I'll be glad to answer any specific questions on the comment section. But I want to leave you with a few things here. Just remember that, because I don't want to turn you into like Wall Street, gurus and have your life focused on financials either. I don't know if that's the best thing either. So a couple of points I put here. First, act on details and not the generalities. Like, be careful when somebody tells you, hey, that's risky, that's aggressive, you might lose your money, you don't want to do that, you want to be more conservative. I mean, those are like, where does that take you? I could have just told you, hey, put your money where it gives you better interest. Buy low, sell high, buy low, sell high. I could have given you that. That's not really helpful, right? Go into the details and act on the details. If somebody says it's risky and mentions something, find out why it's risky. Go into that exact website and see, like, why is it risky? What companies do they invest in? What was their performance like? How did they perform when 9/11, when the crises hit, when bad things happened, worldwide events? How did they perform? And you can see the graph. You know how to read the graph now, right? So again, it's details. When I fly, I don't accept like, hey, you need to fly high. There's a mountain there. You need to fly high. It's like, okay, well, where is the mountain? How far away is it? How high do I need to fly? You have to go on specifics, right? Okay, for number 2, just remember, think about shares. It's about buying and selling shares. The shares fluctuate in value, but it's not like you put $1,000 and you're looking at your money and how much money do I have now? It's more on shares. And I think I want to give like a little card example. So like, let's say like here's a share of a company and it's worth $10, right? So you give the company $10, they give you a share because this is $10. So now you own this. It's your share. And no matter what happens to the value of the share, like tomorrow your share could be worth $8, but it's still a share. You have one share, it happens to be worth $8. The next day your share could be worth $15. Again, it's one share. You don't lose or gain any shares by these price fluctuations, unless they give you dividends. That's a little side note. But for the most part, you bought your share, you keep your share. This is mine, whatever price it is. I bought it for $10. It's now worth $15. Did I gain money? No. A share is a share. Now, if I sell it, that's when I gain money, right? I bought it for 10. I sold it. Someone gives me $15. Yeah, now I made money. I made $5. Likewise, if it goes down, $10, the share is now worth $5. Did I lose money? Nope. On paper, it looks like I lost money, but did I really lose money? No, I still have my share. If you sell it that day, yes, you will lose money. So I'm saying that to you guys so that you don't panic when you see the value of your shares go up and down. You still own your shares. Same thing, buy a share here. The next day, you buy another share. The next day, you buy whatever price, you buy another share. Pretty soon you have a bunch of shares. I don't know what you bought them all for. But when the time comes to sell the shares, you could sell them all if you want. Hopefully you made a lot of money and you need the money. You sell them all, you make a lot of money. Or you could sell them one at a time, You bought this share for $6, you bought this share for $8, you bought this share for $10. And all of a sudden, 5 years down the road, each share is worth $30. You can just sell one, and now you get your $30, and you made a profit, right? Because all these shares you bought for 8, 7, 17, 15, whatever dollars, and you sold that one for 30. Or the same thing, you bought them there, and let's say the shares take a dip, and now they're worth $5, but you really need $5. Well, just sell one share. You kind of took a loss, but you still own these. You just sold one. So anyway, that's think about owning shares. You buy and you sell shares. You're not buying and selling money, I guess, like a bank. All right. So time and consistency gives you the advantage. So if you're in it for the long term and you're depositing every month consistently, most likely history says, for the past, I don't know, 50, 60, however many years, it's always going to recover if there's downtrends. And if you do it consistently, stocks tend to go up on the long term. It goes up and down, but if you draw a straight line from the beginning to the end, it's always up. We talked about dollar cost averaging, about how if you just deposit each time and if the value of the shares go down, now you're buying a lot more with your money. If the shares go up in cost, you're buying less with that same amount of money. And finally, I wouldn't let, my personal philosophy is don't get too intense with looking at the money and chasing numbers and all this stuff. You got to enjoy your life, right? So what I did was, it is very important that you save. But what I did was, when I worked, I put away a little bit. I put away 10%. Sometimes when money was tight, I could only put away 5%. But I put something away. And if you do that, then have fun with the rest of the money. Go on a vacation, buy the nice shoes that you want or whatever. I mean, treat yourself. That's what money's for. Money is a way to get you what you want or need or to help others and that stuff. So if you have that mindset of depositing into the right place first, then you don't have the guilt of spending the rest of it completely till the next paycheck. Live paycheck to paycheck, but take a little bit off first and then live paycheck to paycheck. So those are my parting words. Glad you watched. If you have any questions, feel free to put them in the comments. And thanks a lot. You have a nice day. I'm probably going to go back to my pilot videos. All right, take care.